In this video, the stochastic oscillator. So, stochastic oscillator is another oscillator that is in its own window. And I'll go ahead and pop that up here. Basically, what it does is it measures a couple of moving averages and whether we are overbought or oversold. So it's a lot like the RSI. We have above 80 and a crossover. Gives you an overbought signal. Below 20 and a crossover gives you an oversold signal. There is price divergence, and I'll walk through that as well. However, there's a caveat with stochastics, as they are horrible in a trend, and they are much more reliable in a range-bound market, because the idea is that all things being equal over the last X amount of periods, in this case 14, there's a high and a low, and you just kind of bounce back and forth. The reality is markets do consolidate, depending on the market, anywhere from 70 to 80% of the time. So the stochastic oscillator is a good indicator. You just have to make sure you're using it at the right time. So what I will do, a lot of traders will do this, is they'll put a moving average up. This is a 50-day EMA. And you can see that it's drifting slightly lower here, but it's more sideways than it was here. So what does this tell us? This tells us that we will get a lot of false signals out of the stochastic in this uptrend. But once we become a little bit more range bound, and you can clearly see that there's a couple areas that we're trading between, somewhere around 145 and maybe 130 or so. And now you can start to use the stochastic oscillator. And you'll see that the moving average is crossed over in the overbought area, right at the top. We crossed over here, and that's technically not a buy signal because it wasn't underneath the 20. There's one here, and you can see that's when we started the consolidation. At that point, you can see that the EMA was starting to roll over, flatten out a little bit. So we've had two signals. This was awfully close. You could have perhaps been talked into it. But as you can see, technically it's not there. So the stochastic is a little slower than some other signals or signal producing indicators. And that in and of itself can and will keep you out of trouble sometimes. So let's take a look at, let's do Ford Motor here. And you can see that we're in a trend. Even though we've popped above, now that we're sideways for this time frame, you can see that we just kind of went sideways for a few days and we crossed there. That technically was a sell signal. This was more or less a sideways market for a little while, at least based upon the moving average. And you can see that we did get the one signal. This area here, we got a signal here. We did cross over just barely. This is an excellent signal. We crossed over right here. And we crossed right here, telling you to either get out or go long because you would have been short. This was a sell signal. And that was a closing signal because by then the moving average started to drift lower and you did make a fresh new low. So at that point you have to assume that you're probably not going to continue much higher on the rebound. There is price divergence, as you can see. And that, of course, is a signal. So with the line going basically sideways, getting a little overbought, crossing over there, makes sense. And we did, in fact, go lower over the longer term. And that's the thing about the stochastic oscillator that I would point out. When you do get price divergence, it tends to be a little bit more of a longer term signal by the very nature of the indicator itself. But again, you have to be very careful. You have to make sure that you're using it in a range bound market like this. You know, there's a sell signal there. There was a buy signal right before it. So a couple decent trades. Most people will use these moving averages to give you an idea as to whether we are sideways. Another thing that, of course, helps is if you're at support and resistance, in an area that has two strong levels of support and another level of resistance, two conflicting areas, Typically, you will have consolidation anyway, so that should get you looking at the stochastic as well.